Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is returning guest Ravi Sood, chairman of Galane Gold. How are you today, Ravi?
I'm fantastic, Tom. Great to be back.
It's great to have you back. It's been a long time since we've had you on the show, and I was wondering if we could start by talking a little bit about what the current market conditions are for capital appreciation. The last time we had you on, you were talking about what the tech bubble and the 2008 financial crisis, what kind of factors that created for capital appreciation. And could you contrast that with the situation we're in right now?
Yeah, and I think I'll draw some more parallels towards the late 90s bubble. And what we saw there was some great companies, and the one I always like to highlight was Cisco Systems, which the year 2000 onwards have not been bad years for Cisco Systems. It was a great company 20 years ago, and it's continued to be an absolutely critical part of the development of the internet and the networked world. It's continued to be a absolutely fantastic company. But it got itself to a valuation where, without anything going wrong, it had nowhere to go but down. And that was looking back at 1999, 2000. I did a calculation. I recall doing a presentation in 1999 that for Cisco to justify its multiple, by 2010, it had to be something like 10% of the US GDP, which was obviously implausible/impossible. It didn't materialize. Stock went down a lot, but it was still a great company and did really well. I think there's an element of that here with the market, and looking past COVID-19 and all the question marks and all the unknowns around that and how that's going to unfold, and long-term changes to the dynamics of supply and demand, other geopolitical things going on, changing in the way globalization functions on our planet. Looking past all that, just looking at valuations, where we got to before this whole crisis, before the pandemic, it was looking a lot the same, where no matter what happened, the stock market in general, of course, there's always opportunities in individual stocks and in specific sectors, and sectors rotate. But for the market in general, large cap stocks, they virtually had nowhere to go but down. Absolute record highs in price to sales, PE ratios in the 95th percentile, everything stretched to the max. And that records are meant to be broken. And so you hit highs and you hit all-time highs and you set valuation records. And then sometimes you go another 20 or 30% higher, or even higher still. And that was what was happening. So we were going higher and higher. We had very low interest rates, a conducive environment on many levels, companies doing quite well, and a few absolute leaders, companies like Amazon and Apple, just continuing to grow and show spectacular numbers and pulling the whole market up with them. And we had a jolt with the pandemic. Of course, that sent stocks reeling and put us all into a state of confusion and lots of unknowns. But really, the fundamental issue with broader equities was, where can they go from here under any sort of plausible growth scenario? And back to my original point, nowhere to go but down. And when you buy at those kind of multiples, 100 years of market history would tell you you're going to get mediocre to below average returns if that's your entry point. So where is the opportunity for capital appreciation? It's not gone, but it's not in broader equity markets. I wouldn't look to, buying the dip the way that it's worked so well for the last 12 years. That's just not going to work the same way it's worked, really just from a matter of valuation.
Absolutely. And as we've seen the fundamentals of, let's say, the sovereign debt crisis, the velocity of money, we've seen these fundamentals, all of which should be really good for gold. How are you seeing this market develop as a positive for gold? Certainly, like I said, we've seen the fundamentals, all of which should have been positive, but we haven't seen a real rise in gold. Do you think that narrative is finally starting to take shape in the mainstream?
Well, there's a couple things you said there I think are really important to highlight, Tom. Should be positive for gold, and narrative starting to take hold. And go back to the pandemic. We've seen a good rally in gold from levels that it's seen in the last 6 or 7 years. it has been a good 12 months and 24 months on the gold price. Maybe not as much as the fundamentals would justify, but let's see, and let's look back at this a year and 2 years later. But we have seen a move. Why didn't we see a move 3 years ago, 4 years ago, 5 years ago? Why did we see gold back off almost 50% from the highs it saw in 2011? All the fundamentals and the reasons that things that are driving gold today, the bigger picture items, again, taking a step back from the noise and the confusion around the pandemic and all that's flowed from that, those fundamentals were in place years ago, and they're not something that's just transpired or come together in the last 6 months or 6 weeks or even 6 years. Those have been decades in the making. And this bull market in gold, the roots, I almost hate to do it, go back to 1971 and detaching the US dollar from gold. And all that's transpired in the last 49 years has gone into the making by unhinging ourselves or delinking ourselves from a physical asset and sound money. We've enabled policies that have worked. They've mostly worked, and they've encouraged the governments to continue to use them because they've worked. And there hasn't been any dramatic consequence for the EU, for the United States, even for Japan, from these policies that really would have been impossible in a sound money scenario, were only made possible by delinking from gold. But what happened? Why did gold go up so much in 2011, in the run up to 2011? And then why is it only just starting to catch a bid now? And it goes back to the narrative, the second point you made. That narrative, gold is something where, a small percentage of it is used for critical electronic applications. But for the most part, miners spend a lot of time, many years, lots of money looking for the stuff. Very complicated process to get it out of the ground. Thousands and thousands of people working, billions of dollars spent. And you pull these bars that pull this stuff out of the ground, make bars, and it goes and sits in vaults in Switzerland and Hong Kong and does nothing for the next 1,000 years. So gold is worth what somebody's willing to pay for it in US dollars. Now, one gold bar now, or 1 ounce of gold now, is 1 ounce of gold in a year or in 1,000 years, and that's the part of the basis for gold as sound money. What somebody's willing to pay for it in paper money, that's going to change, and that's going to change with fundamentals in the long term. But in the short term, it's sentiment. And the sentiment is like, where does that narrative sit? If there's a very small clique of gold bugs sitting in Toronto and Vancouver and Sydney and London talking about the sky is falling and the sovereign debt crisis and we're all doomed, and why don't you all buy gold? Then, and Main Street is looking at the S&P 500 hitting all-time highs, and unemployment at near all-time lows, basically structural unemployment of zero in most major economies. Why am I wasting any time thinking about gold? It wasn't in the mainstream narrative. It was vanquished from the mainstream narrative shortly after the last financial crisis. There was a couple-year run-up afterwards, and then it just disappeared into the ether in terms of the narrative. That narrative has started to creep back into the mainstream, and that's what's put the bid in gold. Again, nobody's buying gold to build, some critical application out of it or something like that, or stockpiling it because it's suddenly more useful than it was a year ago. They're buying it because the sentiment's changed, and the realization is there that investors need to own assets that are going to perform in the world where we're moving into this end game of a change in reserve currency. And that narrative, as it accelerates and snowballs, that's what, in my mind, will lead to higher gold prices and more interest in the market, and ultimately percolate down to more interest in gold-related equities.
That leads me right into my next point that I wanted to clarify from my last question. We've seen a rise in the paper gold price. I guess the us as gold bugs we're seeing is that this hasn't really translated into the miners. I'm just wondering if we're starting to see some mergers and acquisitions, some JVs, and as we saw, for example, SSR recently acquired Alistair Gold. Is that a good sign for the gold miners starting to get some traction?
Absolutely, and there's a couple things you've sort of touched on there. One was paper gold and maybe the concept of the paper market versus what's happening in the physical market. But I won't tackle that one just yet. I'll focus on your other point, which is what's happening with equities. And if you're like me and you have a portfolio of juniors and micro caps, and you've been waiting for years saying, well, I'm going to be right on this, and gold's going to move up hundreds of dollars in a single year, and then it's going higher and higher, and boy, things are going to be great for my gold equity portfolio. Then you might be saying, well, yeah, they've gone up a little bit and the liquidity's a bit better, but what's happening here? Gold's really made a move, and the future's looking so much brighter for precious metals. Why haven't they moved yet? But we've seen all the signs. If I were to make a checklist, go back to my days as a fund manager and say, what are the signs? What am I going to look for in the tea leaves to see if a sector is turning around and making a sort of secular shift and starting a secular bull market and coming off a multi-year trough and very painful low? First thing you see is some distressed financings and M&A getting done. Sometimes those financings are in the form of convertibles or toxic debt, things that no management team would ever want to do, but would only do if their very existence is at threat. And then the next big thing you see is some constructive chart patterns and improved volume profile in the largest names in the sector. So in this case, your Barricks, your Newmonts, and we've seen that. Absolutely. They've got great chart patterns. They've had huge improvement in volume. They've all had significant breakouts. The flow of funds into ETFs that invest in those has increased. So check. What comes next? M&A. And the M&A is consolidation among large companies. You see that we saw several mega mergers starting in 2018 and continuing on over the last year and a half in particular. The large cap companies merging amongst themselves, now moving down to buying mid-cap and single producer mining companies and even development stage companies. So the entire checklist, every box as I go down, it's all happening. The last thing that usually happens in a bull market in a particular sector is the small caps and micro caps take off. And looking back at different huge bull markets, there's all sorts of mini bull markets and sectors and markets and jurisdictions year by year for the last 100 years, and we could go on for ages and ages about them. But looking at big ones, highlighting something like the tech bubble of the 90s, you have a multi-year secular bull market, and you have huge volume profile, and you have huge capital appreciation. And within that multi-year, often decade-long secular bull, you will find 18 to 36 months of mania, where things just go bananas and valuations get detached from reality, and the proverbial taxi driver is talking to you about, or maybe it's Uber driver now, talking to you about stocks in that sector. That was absolutely the case at the end of the tech bubble. And we saw it in the cannabis sector in more recent times, was orders of magnitude smaller in terms of gross dollars and number of people involved and volumes in the sector as a whole versus the tech bubble. But I think what we're going to see in this precious metals market is going to look more like the tech bubble of the 1990s. You'll see a huge secular bull market, obviously with some drawdowns in it, but the long-term move is up, and it's up in a big way. And then you'll see, I don't think we're close to it because we haven't percolated all the way down to the micro caps and the mainstream narrative, the Main Street adopting this narrative for precious metals and sound money and sovereign debt crisis. But we will see that in the coming years, and then you will really see liftoff from your juniors and your micro caps. In the meantime, there still be capital appreciation in there, and now is the time where you're buying stocks at 5 cents and 10 cents, which make for cocktail party stories and legendary investment stories 10 years down the road. And people say, I can't believe so-and-so was able to buy so many shares at 4 cents or 7 cents or 25 cents of such and such, which is now trading at $25. And we saw that in the last mining cycle. It was a good one. We had decades of suffering in the mining sector, and it was broad-based. You had uranium, you had base metals, you even had coal, iron ore, all the bulks, everything worked. and it worked in a big way. And that was driven by the rise of the East and coming off depressed levels of decades of underinvestment. But I think this one's going to be, for precious metals, it's going to be even more aggressive and substantial in terms of capital appreciation and how much it invades the Main Street narrative and really captures investors large and small around the world. And for that reason, I think it'll look more like the 90s tech bubble than it will the 2000s big mining cycle.
Excellent. As we talk about capturing the mainstream narrative, something that I think anybody that's been paying attention to the space is going to look at is the disparity between the paper markets or the future markets and the physical price of gold, silver, precious metals. Could you share a little bit about how you see that disparity and why it exists?
Yeah, I have as many questions myself as somebody deep in the sector, as an operator and investor for many years. I still have probably more questions than I do have answers, but a few anecdotal things I can share. One in particular about one of our own projects where we needed an off-taker for gold concentrate we were planning to produce at a new mine. It was a past producer, and it was something we were looking to restart in 2016, 2017. And we explored the market. There was not much interest. It was lukewarm at best. And the terms that we were presented by potential off-takers were not very attractive. So it didn't quite meet what we needed to see or what we thought we could get for that project. We were also looking at a period of low gold prices. We pushed it off and ultimately really got going in 2018 to restart that mine. And when we went out to the market looking for off-takers, and keep in mind, this is physical product, we had much stronger response, and the terms were better than we'd expected and quite favorable to us. And it was not difficult for us to get it done. So that was 2018. Big difference over 2016. There was a huge amount of interest that we didn't see 2 years before. Fast forward to Q1 2020, so just the last few months, and sitting at PDAC, the mining conference in Toronto, I met with 6 or 7 different off-takers. Most of them had just cold called us. These are high-quality global firms, people I had no relationship with, and they had tracked us down and saw that we'd done concentrate offtake in recent years and pitched us potential terms and deals. And they were on, again, materially better terms than we saw in 2018. So we went from scraping and scratching in 2016 and virtually no market to better than we expected and surprising depth in 2018 to people literally cold calling us in 2020. So something's happened there. Exactly what's driven that? Okay, I have a bunch of theories and many others do as well. But rather than trying to figure out the causation, I think the observation is that there's a totally different demand for physical metal than there was 2 years ago or 4 years ago. Now, theories as to why that is, well, I think, again, it goes down to the narrative seeping down to Main Street. And year after year that we've seen gold, those of us in the gold industry keep calling it gold moving east. And every year, more and more gold. It's in China, it's in India, it's in Russia, and it's leaving loose holders and going into the hands of people who value it or view it in just a very different way than most people in the West have viewed it for decades or even generations. And I can tell you, as somebody of Asian background and also somebody who's lived in Asia, it still has a completely different, held in different regard, and always has been, even through the dark years of the gold sector, than it is in throughout most of the Western world. So Russia is a great example, starting in 2014, virtually liquidating its U.S. Treasury position, its U.S. dollars as part of its reserve base, and continuously, aggressively migrating that towards gold. That's gold physical gold that's just come off the market. Those are actual bars that are leaving the hands of bullion banks and loose holders, and people leverage them and use them to lend out, and are sitting with central banks that are going to hold them and add to those holdings probably for the rest of our lifetimes. So that's you're going from weak holders to strong holders. And that happened for many years and didn't seem to have much impact on anything. And as to paraphrase Hemingway, how did it happen? Well, very slowly at first, and then all of a sudden. So I think that's the phenomenon we're looking at here, which is it's not an issue until it's an issue. And it looks like it's an issue now, where physical gold is actually a thing. And we've seen people with the inner eye, like Eric Sprott, who've seen into the future and said for years, you don't want to own these ETF products that say you own gold, but you're actually quite abstracted from it, or you have counterparty risk, or there's banks in between, or do you really actually have the gold? I'm now reading articles all over the place and seeing media speak to that issue quite broadly. And that's something that's snowballing. And I'm not talking about Eric Sprott. I'm talking about people far more abstracted from the sector and really just coming into it, talking about it. So as that narrative snowballs, the issue will snowball. And I think, it's not going to be 5 years from now. It's going to be in the next 12 to 24 months. We're going to see some sort of serious detachment between the value of physical metal and this paper market, and perhaps some sort of real evolution or revolution in the paper market to deal with it.
As we think about trying to profit from physical, the other side of that trade obviously is looking at the miners. Could you explain to us a little bit about how the gold price moving up for you guys as Galane increases leverage and increases your free cash flow, and kind of how that translates into how people need to evaluate junior miners such as you guys?
Well, it's there's no business quite like it. Gold is really quite a magical business to be in for a few reasons. And let me just take you through this example. If I'm Toyota and I have a great car, the Toyota Corolla, and I make, I don't know how many they make, 1 million of them a year or 10 million a year, and I make some amount of profit on that because I'm a great company and I know how to operate and I have a margin, and that's a great business. And maybe the economy is booming and I can sell a few more and I can charge a little bit more and sell a few extra features, and my margin goes up, gross margin goes up a point or 2 points. What if I'm a copper producer? I can have much more boom and bust, can't I? Because the price of copper moves up and down quite a bit. Probably doesn't get too much below the marginal cost of production because people need to consume copper. And if it's below the cost of production, mines start to shut down. So it kind of has a floor there. And, some guys are going to be making a little bit of money at those low prices. Some are losing a bit of money. And then it goes up and more supply comes on, and you have guys have an expanded margin. The gold business is unique. So the amount of gold that trades and the amount of gold that's sitting above ground is 50 to 100 times what's produced in a given year. So you're increasing the gold supply by about 2% a year in and year out. The amount of gold above the ground is way more important than the amount of gold that's being produced in any given year. So gold can go well below the marginal cost of production. So you can wipe out producers and it doesn't matter because there's still the same amount of gold above ground. It doesn't have a significant effect on the entire market. It can also move up rapidly and have almost no effect on the supply side response. There's almost no other business in the world where that happens. I can't think of any. Price soars, and no matter what gold companies do, they cannot significantly increase their production or suddenly find more gold and bring it online to respond to that higher price. It takes not years, but even decades to start to create new supply of gold. So what that sets you up for is an incredible boom-bust cycle. And the opportunity for capital appreciation there is like no other. So I'll give you some specific examples. The Galane, our flagship mine for many years, has been the Mupani gold mine. All-in sustaining cost is about $1,050 at the mine level. We have a little bit of top company expenditure amortized in there. That's, let's say our total cost of production is $1,100 an ounce. So in the lows over the last 6 or 7 years, we saw $1,100 an ounce. So we weren't making any money. We've probably averaged through the 5 or 6 dark years about $1,200 or $1,250 an ounce gold. We made a little bit of money. You could say $100 an ounce, $150 an ounce of gold produced ounce of gold produced. But now look at the exponential change in margin. This isn't like getting an extra point or 2 points because you sold an extra Bluetooth feature on your Toyota Corolla. This is talking about going from $100 an ounce of margin when gold's at $1,200 to $600 an ounce of margin when gold's at $1,700. So you have 6x the profitability, and that has staggering effects on your valuation, obviously. The other thing that's happening at the same time is that you have an expansion in your potential reserves, your reserve life, the amount of gold you can get at economically, because as you use higher gold prices and lower your cutoff grades, or and basically change your pit design, your mine design, you can get a lot more gold. So you're getting a double whammy on the way up. It's an exponential increase in the value of your company. It cuts both ways, though, of course. So when it's going down, it's not pretty at all. You're having this massive compression of your margin. It can go negative for long periods of time. It constrains the amount of gold that you get economically produce as the price goes down. And as a result, you have this hyperbolic response to share prices. Share prices, stocks that are $10 can go to 10 cents when you're on the wrong side of the cycle. But when you're on the right side, those 10-cent shares can go back to $10 really quickly. So now is the time to look for management teams and opportunities and horses to back for companies that you're getting in at and I'm just using the number 10 cents. It could be 50 cents or $1. It doesn't really matter, but really great entry points into companies that can participate in this cycle and deliver that exponential type of return to investors. And the next question is, well, when do you sell? That's a whole other discussion, and very difficult, and maybe even the more difficult question. But now is just a stunning entry point. Things haven't moved very much relative. You could still buy these stocks at prices as though gold had moved up $100 or $200. It's moved up $500, and it has all the makings of going much, much higher still. And you're still buying them at these discounted prices. So tremendous opportunity for companies like ours, for investors to come in and get into these companies with that exponential leverage to gold price.
As we're speaking about different horses to back, Ravi, your two projects are located in Botswana and South Africa, and I was just wondering if you could address maybe some of the criticisms that would come with having projects in those jurisdictions, if there were people that had criticisms on not being the, let's say, the most preferable jurisdictions to have a gold company.
Yeah, and I think jurisdiction is important for a couple reasons. With gold, you have to look at, what's the potential risk of government policy changes around gold specifically. And then, of course, as an operator, what's the reality of operating in a country, permitting, environmental, logistical issues, that sort of thing. I've spent a lot of time working in Africa in my career, concentrated in the most difficult countries, the DRC and Liberia in particular. And with Galane, we're in Botswana and South Africa. Now, I'll put those two countries, Botswana and South Africa, in a completely different category than much of Africa. Botswana is a really anomalous country. It's in most rankings, Fraser Institute and equivalent, it's top 10 or top 20 in the world in terms of mining jurisdictions. Great place to do business. Rule of law is absolutely strictly enforced. Logistics are quite good. English language, no complaints, really no issues there. It's been a great place to operate, and others have had the same experience. South Africa, there are positives and there are negatives. On the negative side, you have the BE requirements. So you do have dilution to local shareholders, which is something that you have to deal with. That's just the reality of operating there. That's been in place in some shape or form for over 20 years. It more or less works. It's kind of a cost or a factor of doing business, and you have to deal with it. In terms of unions, that's something you have to work around and manage. The government has certain issues dealing with them. The flip side with South Africa is it's kind of the supply chain for much of Africa, particularly with mining. So, and the infrastructure there is unlike almost anywhere else in Africa. So you've got sealed roads, you've got sources of supply for almost everything you need, including skilled labor. including highly skilled labor. Many of the CEOs of the world's largest mining companies are South African, born and trained and educated. And you have a culture of mining, which is 100 plus years old. So it's been a critical part, maybe the most important part of the South African economy since the existence of the country. So the government is relatively sophisticated. We haven't really experienced any issues around permitting or anything like that. Logistics are excellent. We source almost everything we need in country. All our staff is, not all of it, but almost all of our staff is South African. So it's a mix. Would it be easier to operate in Manitoba or Nevada? Absolutely. You've got positives of local staff, local resources, great jurisdictions, easier access to capital. But as Africa goes, Botswana and South Africa are excellent places to operate. And I would, having operated there for just short of a decade in those two countries, I would do another deal in those two countries in a second. Other places in Africa, I would also do a deal. Other places, I wouldn't.
Just one thing that struck me there. What do you think the multiple of the cost of labor is between, let's say, Nevada and Africa?
It depends. So I can't answer that question for all of Africa. So let me give you my experience over 10 years working in the Congo, the DRC. I'd say the cost of highly skilled labor is way higher there. Reason being, you have to find expats that are willing to work there. You have to provide all sorts of benefits, higher salary, usually also cover tax payments, health care, private school for their kids, business class flights, expensive insurance, a laundry list of items. And the total cost of those highly skilled employees is not just higher, it's way, way higher. So that's a bit of a myth that you're going to save money by operating in Africa. That just isn't the case in most places. Sure, your lower skilled labor is going to be less expensive, but in my observation, most of your labor cost is your highly skilled labor. And if your highly skilled labor needs to be imported, then your costs are going to go through the roof. Flip that around and apply it to Botswana and South Africa, totally different picture. You have highly sought after professionals from Zimbabwe and in particular South Africa, people who are working all over the world. You know, even in Canada and Australia, there are many South Africans. And as I said, many of the largest mining companies have South Africans as CEOs. And those people are working in South Africa, getting paid in rand, which is depreciated year after year and is a very inexpensive currency, and purchasing power in South Africa means that, you know, you're effectively in dollarized terms paying a lot less for really highly skilled people in South Africa. So you get the double benefit in those Southern African countries where you can source, highly skilled, highly educated South African labor for particularly for mining, where they just have so much expertise. And in some categories like complex metallurgies or underground mining, really just the best in the world. So I would say, you know, for the top people, you're getting them at the same price or less than you would in the United States. And then for middle and lower skilled labor, then you're getting, fraction of the cost. So you're looking at 20% or less of the cost that you would for the equivalent resource in Canada or the United States.
Excellent. That's very interesting, Ravi. Doing some research before this interview, looking at your resume is unbelievable. You're a man of very diversified, let's say, interests and expertise, from a gold producer to a renewable energy producer, merchant bank, cannabis producer, and even you were the chairman of a palm oil plantation. I just wanted to get your take on, we've recently seen the Planet of the Humans documentary, which had a very negative view of renewable energy. And I was wondering what your view is on, let's say, the negative criticisms of renewable energy and why it is that we need to continue to go in that direction.
So there is some truth that, nothing is a perfect solution. So when you talk about, erecting massive, wind installations onshore or offshore, huge solar farms, hydroelectric dams, there is a environmental consequence to that as well. So, a hydroelectric dam being the most severe, you're diverting waterways, you're changing ecosystems in a fundamental way, huge carbon footprint, millions of tons of cement. There is a cost to all of these things. Offsetting that, you have the same capital costs and sort of carbon footprint to a lot of the alternatives. So if your alternative is like, let's not use electricity, sure, okay, that's got a very low carbon footprint. That's just not the reality of the world. I mean, we've got the world's consumption of electricity is a non-decreasing function of time. As civilization has advanced, we use more power. We use it more efficiently. We use it in different ways, but we just use more year after year. And I think that's a reality to acknowledge. If I build an old style hydrocarbon consuming power plant, that has a carbon footprint to the construction as well. There's a huge capital cost, huge installation involved, and so forth. Nothing has zero cost. So you got to focus on where do you get a very long-term benefit that's substantial to justify that. And a hydroelectric dam done properly, the huge amount of oversight and scrutiny, and in places where there's an extensive set of requirements to get such a project approved and built, there is going to be ecological damage. There's going to be changes in ecosystems, changes in communities, human and otherwise, that are caused by it. But you can have for decades and decades a very green source of power. And same thing goes for windmills in particular. So there is, it's a visual damage. You have to see the things. It does kill wildlife. There is a precedent for that, and that is known. And there are ways to mitigate it, but it does happen. And it fundamentally alters wind as a resource. Wind is something too. And if you're consuming it and absorbing it and, turning it into electricity, it's changing something. It's hard to measure what exactly the consequence of that is, but and it probably is very little in the current footprint of wind consumption around the world, but it is something. But you have potentially huge life to these. So I'll give you more specific examples. You get a turbine being the primary or the largest part of your capital expense on your hydro or your windmill, and that hydro turbine can be 25 years under warranty, with almost no decrease in efficiency over that time frame. There are turbines that have been working for decades longer than that 25-year limit. Same thing goes for wind. You have a high-quality turbine manufacturer. You'll often get a 25-year warranty. That windmill sits there almost zero touch, minimal maintenance if it's installed properly with good manufacturers, and producing energy for decades. Decades go by. You replace the turbine with the latest and greatest technology, get a 30, 40, 50% improvement in efficiency and translation of the wind resource into electricity, and it goes for another 25 or 30 years. So there is a lot of positive things going on in the renewable sector, and there are a lot of benefits. Also, just again, speaking as somebody who's lived in Asia, India, China, Hong Kong, where I lived for a couple of years, the quality of air, you just have to live there. You don't for visits. You don't have to live there in any of these places, and see what the quality of air is like and what that means for people living there. And then come back to Canada or much of Europe or Australia and experience air and the air quality and see what the difference is when you have the incredible density and consumption of hydrocarbons and pollution in the air that results from it, and see where this world has to go in terms of the use of renewables. What's amazing, I think, we've seen a critical tipping point in the last few years where in most jurisdictions, if you're installing the right kind of renewable, as in putting solar panels where it's sunny and wind turbines where it's windy, and you don't have to rely on subsidies anymore, they can economically compete and even bankrupt fossil fuels. So that means we're at a level where now the technology is improved, and guess what? It's only going to get better and better. Where you can, there's really no economic reason, never mind needing a green reason or environmental reason to do renewables. You can do it for purely economic and financial reasons. You can beat fossil fuels with prevailing technology with renewables. And that's a phenomenal change where you're looking at solar from 15 years ago where 90+% of the economics were subsidies, which means that somebody was paying for that somewhere and doing so to encourage that technology and to encourage a green revolution and the hopes of a better future from it. And it's worked because now you can build solar panels in reasonably sunny places and compete with fossil fuels and make a profitable operation out of it. It's absolutely huge.
Excellent. Well, thanks for your insights there, Ravi. As we wrap up, could you share with us where we can find out a little bit more about you and about Galane?
I don't know why anybody would be particularly interested in me, but certainly Galane Gold, our website, Galane gold.com. And, we try our best to get information about the company and what we're trying to do out to those who are investors or interested in becoming our investors and share, whether it's through presentations or videos or interviews that we give and get those out in front of people.
Excellent. Well, thanks for your time today, Ravi.
Always a pleasure.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?